I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, the Fed continues to project near zero rates, at least through 2023. Stocks reverse losses. We'll cover how the tech sector fared. Plus, Disney shares get a bounce after CEO Bob Chapek says California's Disneyland will reopen April 30th. That plus the status of Disneyland parks around the world and strides in streaming from my one-on-one interview with him coming up. And it has been nearly a year to the day that Uber CEO Dara Khosrowshahi told us the U.S. shutdown was scarier than 9/11. What are his thoughts today? He'll join me. Plus, connected fitness caught fire. I'll also speak to Peloton CEO John Foley. Two important leadership discussions as we cover the pandemic 1 year on. Those big interviews in a moment, but first the markets. U.S. stocks took their cue from the Fed, which signaled it'll hold interest rates steady. Bloomberg's Ed Ludlow and Kriti Gupta will paint the picture for us. Ed, what are you looking at?
Yeah, financial markets kind of giving a collective sigh of relief, particularly in equities markets after the Federal Reserve said that rates would be near zero to at least through 2023. And it was interesting what we saw in equity markets. The S&P 500, which is the main gauge of US equities, closed up 0.3%, but it had been earlier prior to that decision. The most pronounced move we saw was in tech stocks. You see the NASDAQ 100, a very tech-heavy index, closing up 0.4%, but it had been down by as much as 1.5% before the Fed decision came out. A very similar move in the NYSE FANG Plus index, that basket of mega cap tech stocks. And that's been a big story, right? Rising yields, the question around the rate path with those tech stocks that have such stretched valuations. If you look at the US 10-year yield, we actually came off 1 year highs. The yield on the US 10-year, 1.64%. Come with me into my Bloomberg and let's get some context here by looking at this chart. There has been all this concern about valuations in tech stocks. This chart shows the forward price to earnings ratio of tech stocks relative to the broader S&P 500. Basically, there's a 20% premium right now on tech stocks over the broader index. But if you go all the way back to March 2000, in other words, the dot-com bubble, that was as high as 129%. So now, as I said, there's this collective sigh of relief. We know where we stand with interest rates. We know that those yields have kind of backed off over the last 24 hours or so. So it raises the question, have these valuations on tech stocks got a little more room to climb? Could they go a little bit higher? Because we are no way near the premium that we were about 20 years ago. Finally, I also want to talk about semiconductors. It's such an interesting space to watch right now. The Philadelphia Semiconductor Index, or SOX, you can see it's down 2% over the last week. The jaggedy line tells the story, right? There is volatility here. Samsung out overnight saying that there is this ongoing global chip shortage, that it is continuing, and that for them, that might mean, Samsung, one of the biggest chip makers in the world, by the way, that might mean delaying some handsets. So it's one to watch as well. A lot of volatility in semiconductors right now.
All right, Ed Ludlow, thanks so much. Let's go to Kriti.
Well, Ed, you mentioned those chip makers. I want to look at another chip maker that was one of those stock movers today, and that is Intel, having quite the turnaround story. Starting the session in the red, you can see that right at the bottom of the chart, and then really changing the story at 12. Now, they are dealing with some legal suits, investors saying that they haven't been completely honest with their production timeline. But then at 12 o'clock, you saw a tweet from their CEO coming out and saying that they are actually going to be addressing new innovation, new leadership, all coming on March 23rd. You saw a lot of anticipation for that just built into the stock. What's interesting, though, is that they may be addressing some new competitors as well. If you flip up the boards and look at some of the other movers today, I want to bring to your attention Amazon's monster gain, 1.4%, of course, in line with that tech move that you saw in the broader market. But what's important to keep in mind here is that Amazon's actually entering the chip business, too. And not just chips, they're also entering telemedicine. And that's where you saw them weigh on Teladoc as well, one of those leaders in telemedicine, getting a price target cut over at Deutsche Bank. And of course, not all tech is created equal. I don't have to tell this show this, but of course, you're seeing those media names under pressure as well, not joining in on that big tech rally, Emily.
All right, Bloomberg's Kriti Gupta and our Ed Ludlow, thank you both. Meantime, Facebook has announced new rules to better police private and public groups, including harsher punishments for users and group administrators who repeatedly violate the guidelines. Let's get the details from Bloomberg Tech's Kurt Wagner, who of course covers Facebook for us. So Kurt, Facebook getting a lot more aggressive here. We know how controversial some groups have become. What exactly is Facebook doing?
Well, there's two types of punishment here. You can either be punished as an individual user, or you can be punished as a group administrator, and your entire group can kind of be punished. Now, if you're an individual user and you're constantly breaking the rules, Facebook says it's going to limit your ability to interact with groups. So they might put you in timeout, basically. You can't post, you can't comment, and that includes all the groups that you're in, not just the groups where you might be violating the rules. Now, if you are an administrator of a group, and you're continually breaking the rules, your group might not be recommended to people. It might not show up in the news feed for people. So they're basically trying to de-incentivize or incentivize people to behave appropriately and punish people when they're violating the content rules.
So tell us a little bit more about why Facebook is doing this and why now. I mean, these certainly seem to be things that Facebook should have been doing all along, but of course we've gone through a very contentious election season. We're in the middle of a pandemic, lots of different opinions. Give us the context.
Yeah, I mean, to your point, this probably should have been done long ago, but I think over the last year, we have seen both the good and the bad of groups, and particularly the bad, right? You think about QAnon, you think about vaccine misinformation, you think about election misinformation. A lot of that stuff really percolated in groups, right? Lets people find each other who might have kind of fringe viewpoints or believe some of these hoaxes. And so I think Facebook, we saw them right before the election say, hey, we're not going to recommend political groups anymore. It was kind of a realization that a lot of people were using this product for things that they didn't want them to be using it for. So I think we've kind of had a reckoning there. But, CEO Mark Zuckerberg has made groups a huge part of Facebook's future. He says it's really important to build community. So it's an important product that they're finally getting around to cleaning up. But to your point, I mean, this probably should have been done a long time ago.
All right, Bloomberg Tech's Kurt Wagner, thanks so much. We'll continue to follow. All right, coming up, the pandemic has kept well over 1 billion people on lockdown, setting up a major stress test for the sharing economy. Uber CEO Dara Khosrowshahi joins us next to talk about the last year in ride-hailing, delivery, and their future in a new normal. And after a year of being closed, California's Disneyland is set to reopen April 30th, with associated hotels opening the day before. We're going to hear from Disney CEO Bob Chapek, his optimism about the parks and the rest of the year. This is Bloomberg.
We're thrilled with the response that we're seeing from our guests in terms of future reservations and intent to come back to our parks. I think it's a function of two things. Number one, confidence that we're seeing the light at the end of the tunnel for the pandemic, but also a tremendous trust in our brand.
Take me back to March 2020. The pandemic hits and the lights go out literally at thousands of small businesses across the United States. What was that moment like for you?
Probably the best word is terror. It was a scary moment, I think, obviously for America, for small businesses, and especially for Yelp.
This is a scary time, and it's scary regardless of whom you are. I think my instinct is that we're finally taking the right steps to move in a good direction, and certainly Asia, China, Hong Kong, et cetera, have set a great example for us to follow. But this one's pretty tough.
The first dark moment was when we had about $1 billion of cancellations from guests.
These are unprecedented times and these are scary times. And of course, it's not going to be business as usual for any business. So we're all watching this carefully.
In the long term, I think COVID is just a little blip in a historical footnote, kind of like the 1918 pandemic that we read about today.
In many cases, it's a crushing and testing and trying experience for many.
Leaders there of some of the world's biggest tech companies I spoke to over the last year as they navigated the early days of the pandemic. Among them, of course, Uber CEO Dara Khosrowshahi. Shares of the ride-hailing service plummeted a year ago when lockdowns began, but have since gained almost 200%. Dara joins me now to reflect on the tumult of the last year and look ahead to the post-COVID world. Dara, it is almost a year ago to the day that you said, and I'll never forget this, that it felt scarier than 9/11. Now that you have lived through this last year, how do you reflect on that feeling today?
Well, I think the feeling reflected the reality that we've seen. This is an event that has affected everyone around the world. I think no one has escaped the tragedy that this pandemic has represented. And the effects have been obviously long lasting. It's been over a year. We now see the light at the end of the tunnel, but we are by no means there. And I think there's a lot of work to be done to get there. And just like September 11th changed the face of travel and how people traveled, et cetera, I think that the pandemic is going to really change the way that we live and we work. And I think some of those changes remain to be seen.
Uber has also transformed dramatically in the last year. You've doubled down on food delivery. You've made some acquisitions. You're getting in on grocery. You've also sold equity stakes in the self-driving unit, flying cars, electric bikes. How much different is the Uber that you're running today than the Uber that you thought you were going to run when you came from Expedia?
Well, I think it's very different, first of all, in that when I came from Expedia, really, Uber was about mobility. All the questions I asked, all the research that I did was about the mainline rides business or mobility business. And Uber Eats was this kind of cool thing that Jason Droege and a couple of other folks had built, but it was, it was a growth vector. But I would have never, ever anticipated that the delivery business would get to the 50 billion run rate that we're talking about now, just 3.5 years later. And I think, that's as big as the Uber Rides business was. So we've essentially built another Uber, partially because of the great work of the teams who built that business, but also benefiting from the pandemic and the onrush of commerce to the home. We've been one of the beneficiaries, and I think we've executed really well behind that. So I think the result of all this is a bigger Uber, a more diversified Uber, and really an Uber that's about going to places and getting anything within your home, becoming a bigger and bigger part of your life. It has caused us to sell or merge some of the pieces of the business that we consider non-core, partially because the delivery opportunity is so big and we wanted to double down on it and really focus on making sure that we deliver on the promise there. And we still got a long way to go.
Well, and you still have equity stakes in Aurora, in Lime, in Joby, in this $13 billion investment portfolio. And I wonder what the strategy is there. Is Uber a VC now?
We're, I'd say by no means a VC. Listen, on the investment portfolio is significant, and we think the value of that investment portfolio is going to grow. We also have a very large stake in Didi, who's a big rideshare player in China, Grab, a joint venture that we have with Yandex as well. They're all about mobility and delivery ecosystem. So any investor who invests in Uber gets a benefit of the mainline business and networks that we're running, this delivery and mobility network on a global basis, and also gets further growth from the ecosystem that we have developed through some of these partnerships. Either way, it's going to be a win-win.
So as the world starts to open up, what is the picture of demand you're seeing? We've heard speculation about a roaring 20s style return. Is that how you would characterize it? And how are you preparing to ramp to meet that demand to make sure there are enough couriers and drivers to serve all your customers?
Well, while sometimes it might feel like it, I wasn't around in the roaring 20s to exactly give that characterization. After this year, I feel like maybe I was. But we're definitely seeing trends that are encouraging. Our bookings, February over January, month on month, increased 15% on a month on month basis. March is stronger than February as well as we see things open up. And we think there's more to go, right? The minority of the population has been vaccinated. Things have not completely opened up, but in certain markets like in Miami, our mobility business is down only 25%. So it's getting back to close to normal. And remember, we have very little airport activity. And our delivery business is growing over 100%. So we might see for Uber a period in which we're hitting on all cylinders, which would be a pretty significant positive going forward.
Now, you just announced a dramatic change in the UK, reclassifying 70,000 drivers as workers, not full-time employees, but they are entitled to more benefits like vacation pay, for example. What kind of conversations are you having about doing this in other countries? What will Uber be doing voluntarily to improve conditions for drivers in other places when it's not a matter of the law, like in the UK or in California?
Yeah, absolutely. The worker designation is a designation that's unique to the UK, right? It's not a full-time worker. It comes with flexibility, but it also includes benefits that you talked about as well. And we have argued quite proactively now that we believe that the nature of gig work should change, not to take away the flexibility that all of drivers, couriers, et cetera, prize the most, but to include some benefits, whether it's healthcare benefits, vacation pay, et cetera. We call it our IC Plus. We believe that's the right thing for societies to go forward with. And as a result, that theme fit very much into the UK worker model. And we decided we're going to step forward and we're going to do the right thing. Hopefully, our doing the right thing in the UK will lead to others in the industry also following suit. These are discussions that we are having in other countries. Obviously, regulation here is very local. India, for example, recently passed regulation that looks similar, but we think this model of maximum flexibility to earn the way that you want to, along with some benefits, we think that is the future model, and it's one that we're going to support.
Now, you've said this will increase costs, but won't impact profitability. And I've been talking to analysts today, and one of them said, the math doesn't work out, at least my math doesn't work out. So do the math for us, your math. Who's footing the bill for this? Is it going to be passed on to the customer?
Well, I would say that maybe the analysts should check their math. We wouldn't say that we're on track for profitability unless we thought we were on track for profitability and unless we intended to get there. The fact is that the mobility business at maturity, and for example, January, February of last year, our mobility business had segment EBITDA of 20+%. So these are costs that we can bear. It's an additional investment that we are making in our in drivers, and we think it's a worthwhile investment that we will be able to make to build the long-term path forward and hit profitability at the same time. It comes with some risk, but we're paid to take a risk and we're paid to make things work out, and that's our intention as far as profitability goes.
Meantime, Dara, inevitably when I do an interview with you or the CEO of DoorDash, I get tweets from drivers who say they're still not paid enough. And the critics say that the gig economy model may be increasing inequality. How do you respond to that?
I think that, listen, the pay that drivers or couriers make, you can debate whether it's enough or not, but the facts are, for example, that in the UK, our drivers already earn, in London, for example, already earn approximately £17 per hour. That's about $24 an hour. And that kind of pay is significantly above minimum out there. We think earn that kind of money and have absolute ability to work when you want, how you want, where you want. We think it's a compelling value proposition. So, $17 an hour is a decent number. And with flexibility, it gets to be a pretty compelling way to earn.
Now, you've said that Uber won't be investing in Bitcoin. but it's continued to see an incredible rise and more corporate acceptance. Are you sticking with that? And any more discussions behind the scenes about plans to accept cryptocurrency as a form of payment?
Well, I actually talked about, we would look to accept Bitcoin or other cryptocurrency if the demand is there, if the economics are right. As far as investing in Bitcoin, it's not something that I see near term. Maybe it'll change in a couple of years. But remember, we're not profitable yet. The risk of the company is still a company that is pre-profitable. So usually your investment activity as far as a treasury shouldn't be about speculation, or shouldn't be about, we're not going to make a bunch of money because of our treasurer. We're going to make a bunch of money because our operators get there, and our treasury is going to keep us safe as we journey on to profitability.
Meantime, Dara, as we've been speaking, Brazil just reported more than 90,000 new cases of COVID-19. You obviously have a huge business there. In your view, is the crisis nearly over, or is it still far from over?
I think that there is a light at the end of the tunnel, as I said, but the crisis isn't over. There's a lot of wood to chop between now and then. We've got to stay vigilant in terms of masking up, in terms of keeping our distance. And the challenge of vaccinating billions of people all around the world, it's a shared challenge that we all have to contribute to. And for example, we are doing our part in terms of providing free rides and the partnership that we have with Walgreens, helping drivers who are designated as frontline workers get a special code that they can use to get vaccinated at a Walgreens. There's a lot of work ahead of us, and I think the road back is absolutely happening, but it's going to be bumpy. And I think we all have to work together to get there as quickly as possible.
All right, Uber CEO Dara KHOSROWSHAHI, thanks so much for joining us a year on. We will keep watching how the company continues to evolve. Much more when we return. Stay with us. This is Bloomberg. Robinhood is offering a new promotion for traders just as millions of Americans receive stimulus checks. The trading platform is offering some customers bonuses of up to $250 for new deposits the next 2 weeks. The offer comes just weeks after Robinhood's co-founder was grilled by lawmakers about features that critics say entice users to trade excessively. Coming up, we're going to hear from Disney CEO Bob Chapek about the plan to reopen Disneyland next month, his outlook for the rest of the year. Also, Peloton CEO John Foley. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. California's Disneyland is set to reopen April 30th with limited capacity more than a year after being shut down amidst the pandemic. During this time, the company has doubled down on its streaming efforts with Disney Plus and ESPN Plus. Ed Ludlow has more. Ed?
Yeah, so Disney is one of the stocks, one of the companies of the pandemic, right? Disney Plus, such a big part of that. But come with me into my Bloomberg and look at this chart, because if you go all the way back before the pandemic, you have to remember that the parks was such a big piece of the Disney story. The Bloomberg terminal, which hopefully we can get up in a second, shows that as a proportion of overall revenue, here it is, parks, experiences and merchandise was topping 40% in many of the quarters leading up to the pandemic. You can see on the far right-hand side of your screen, it then drops off, but there's signs of recovery. So it's kind of no wonder that investors are cheering the reopening, because once again, it will continue to be an important contributor to the top line. But Disney Plus really is the story. And if we take a look at how subscribers have grown for Disney Plus, look at that. Astonishing. At the pace of growth since launch to more than 100 million subscribers today. So where does that leave us? Like, what is Disney? Is Disney a media company? Is it this great entertainment giant that we've always known? Well, if you look at its share price against Netflix, which is trying to catch up within the streaming space, and also Six Flags, which of course is the theme park, isolated theme park company, you can see over the last 12 months, Six Flags has done astonishingly well. It's recovered. It's part of this reopening trade. Then Netflix, which did so well at the end of 2020, the stay-at-home trade of all of us streaming, That recovered. Disney's somewhere in the middle. You could argue that it's both a reopening trade and a stay-at-home trade, because as long as we're stuck at home, we're watching things on Disney+, we're streaming. But as the economy recovers and the vaccine rollout improves, look at it there, middle of the pack. It benefits from that reopening because its other business areas then recover, like parks, like cruise ships, like merchandise. So it's certainly one to watch going forward. It's really adapted and pivoted during the pandemic, Emily. But what happens when life goes back to normal? That's what I want to know. Disney.
Right. The company is so different, Ed, than it was even a year ago. Ed Ludlow there, thanks so much. I spoke about all of that with the CEO of Disney himself, Bob Chapek, earlier this morning. He expressed his optimism about the reopening and what the rest of the year holds. Take a listen.
We're thrilled with the response that we're seeing from our guests in terms of future reservations and intent to come back to our parks. I think it's a function of two things. Number one, confidence that, we're seeing the light at the end of the tunnel for the pandemic, but also a tremendous trust in our brand. We've been able to operate across the world, at Walt Disney World, for example, for the last 9 months, and we've done so responsibly. We've had the NBA bubble that was so successful, and I think guests know that Disney's going to do it right, and that brand trust really leads them to want to come back to our parks and experience the magic, and knows that we're going to be responsible as we do that, and they can have a great time.
So the date is April 30th for California, but you've got 15% capacity limits in the red tier. You can get up to 25% if we get into the orange tier. Kids are thrilled, but investors want to know, can you make money with these kind of limitations? No out-of-state residents as well?
As we've said from the very beginning, there's a couple requirements for us to reopen the park. First one, as I mentioned, is we have to be able to do so responsibly and make sure that everybody has a great time while also, being safe. At the same time, we're only going to open up if it could be accretive to shareholder value. We're going to be able to cover our variable expenses and make a contribution towards profit. And that's been the case since we started reopening our parks 9 months ago, and that'll be the case with Disneyland. So we're confident we can do that. And of course, as conditions improve and the constraints are relieved, we'll be there to ramp up and make sure that everyone has a great time and welcome even more people back to the magic of Disney.
So what are some of the new technologies that you've used over the last year that you think might stick around post-pandemic? Will temperature screenings continue, for example? Will you use the reservation system a lot more?
Well, in addition to all the health guidelines that we've been following across the world, masks, temperature checks, increased hygiene, 6-foot social distancing, we're also going to be introducing a new reservation system that's going to enable our guests to have a great time no matter when they choose to come to Disney. Of course, nobody ever wants to go through a pandemic, but our teams here have been hard at work making sure that when we reemerge, that we're going to do so in a way that's actually going to improve the guest experience, even versus a pre-pandemic situation. And our guest satisfaction scores since we've reopened across the world have shown that indeed our guests are even more satisfied than they were prior to the pandemic. We've learned some things. We've learned to operate under constraints all the time by delivering this great same Disney magic that you expect. But we've been in a fortunate situation where we've had a lot of demand in the past. In many cases, that has exceeded what we can actually supply in terms of how many people we can put in the park. And there's been no situation that's been more like that than we've had upon reopening and really having to operate under some really tight constraints. But we've gotten even better and better at it. And I think it's going to create a reemergence scenario where magic is going to be even greater for our guests when they do come back to our parks.
Now, Disneyland Paris looks like it will be the last to reopen. They were scheduled for April 2nd. That's gotten pushed back. Do you think it'll reopen by summer?
Well, we certainly hope so. We follow the guidelines of local governments and local health agencies in terms of telling us when it's safe for us to reopen. I agree with you that will probably be the last of our parks to reopen again. But when it does, we'll be there again to operate responsibly and make sure that we have magic for everybody.
Now, Disney Plus has, by all accounts, been a remarkable success. You just surpassed 100 million users. You released Raya and the Last Dragon recently for an additional premium fee. I know you're not going to share numbers on that, but can you tell us at all how well that early release premium model on digital is working when customers know that they can get it for free just a few months later? Are people buying? Is that something that'll stick around when people are going back to theaters?
Well, there's two reasons to do this right now. One is obviously pandemic oriented, as people have some level of anxiety or about returning to theaters, or the theaters aren't open up in big numbers. And so it gives them an option, gives them some flexibility to watch the film at home without necessarily having to wait for 3-4 months to see it. But also there's some fundamental consumer changes going on where people are becoming, let's say, impatient. They want to see movies the way they want to see them, when they want to see them, and how they want to see them. And we've been thrilled with consumer receptivity to our Premier Access strategy. And whether or not this becomes a big part of our strategy going forward is really going to be up to consumers. You know, they vote with their pocketbooks. They're going to tell us how they want to watch movies, and we're going to, be responsive to the consumer. They're going to drive that evolution, just like they're driving the evolution from linear broadcast world over to a direct-to-consumer world in general.
Disney CEO Bob Chapek there. You can catch that full interview at Bloomberg.com. All right, up next, the company that has single-handedly transformed the fitness industry and kept millions of users fit while stuck at home. I'm speaking with Peloton CEO John Foley about the company's future post-pandemic and beyond. This is Bloomberg.
I'm Mark Gurman with Bloomberg Technology, and on this week's episode of Power Up, I will be taking a look at Peloton and if I think the company will continue to be successful after the pandemic. When the COVID-19 pandemic began to sweep the United States about a year ago, orders of Peloton's pricey bikes and treadmills began to pile up. Users were immediately searching for ways to work out from home as lockdowns and gym closures spread from coast to coast. During the 4 fiscal quarters covering the pandemic, Peloton generated nearly $2 billion in revenue. That's about $800 million more than it made in the 4 quarters before the pandemic began. That has led to a key question from investors and analysts. Has Peloton simply become a COVID stock? One whose revenue will decline back to normal when the pandemic finally ends? I don't believe that will actually be the case. That surge in users has further popularized the Peloton brand to the point where people are buying the bikes and treadmills simply because their friends have them. People could also begin to prefer working out from home rather than the gym after getting used to it for a year. Peloton also charges users fees to access its full array of content. So that's another recurring revenue stream that will remain even if hardware sales do slow down. A few months ago, Peloton also said it is buying Precor, which will enable the company to release equipment designed for commercial environments like hotels and gyms. Peloton says it expects fiscal 2021 revenue to top $4 billion. Still, while signs for continued Peloton strength are present, Peloton could have some serious challengers in the offing. Apple's fairly new Fitness Plus service is certainly compelling, and it has drawn interest from many people inside the over 1.5 billion person strong Apple user base. There could also be a percentage of people who want to work out with a wearable instead of an even more expensive piece of machinery. Echelon and Nordic Track also have often cheaper equipment with many strong features of their own. Regardless, it still appears that Peloton is here to stay for the long term. For Power Up, I'm Mark Gurman.
Thanks, Mark. For more now on Peloton, we are joined by the man himself, the CEO of Peloton, John Foley. John, thank you so much for joining us. Obviously, it has been an unprecedented year for you. The surge in demand, the unprecedented challenges to meet that demand, you leading the company through it while dominating the Peloton leaderboards, by the way. Talk to us about how well you think, looking back on the last year, how well do you think Peloton met the moment?
I think we did really well. I was super proud of our team. I mean, it was unprecedented and unanticipated. Of course, we've grown 100% year on year since we launched the company, so we were planning to have a great growth year. But We just had a team meeting this morning, and our manufacturing team told us that over the last 12 months, they've grown supply 700% since this time, or the capacity of supply 700%, which is just crazy Herculean to try and keep up with the growth. So, Emily, I think you probably saw that our instructors were innovative, and our content team were, once our studios closed, we moved the instructors to their homes, to their living rooms, to their bedrooms to be able to stream fresh content to our members. Our stores closed, and those retail folks jumped on the phones to help people get on board with Peloton treads and bikes, and on and on. I feel like we've been there for our members. We've welcomed hundreds of thousands of new members, and I've been really pleased. I've been incredibly proud of the team.
John, you're absolutely right. I spent a lot of time with Bex Gentry. She is my favorite. But look, the big question is, how does the growth evolve post-pandemic, gyms reopening, life settling into a new normal? What does the demand picture look like to you as vaccines roll out and after vaccines are done?
Yeah, so about 6 months ago, there was a survey done by a national company that said that they found that 59% of Americans are not going to go back to the gym after COVID's done. So this whole idea that you can now get better workouts at home without traveling at a better value, because on average, a Peloton workout costs around $2 per workout when you think about how much members and their families are using, their spouse are also riding or running on the Peloton treads or bikes. And so it's a better value, it's a better location, better instructors. To your point, we believe we've got the best instructors in the world. So with the better experiences, a better value, a better location, that's undefeated. And so I think the word is out that Peloton has these experiences. Like you just heard, the word of mouth is really helping us because people get addicted to them. They say, why would I go back to the gym? Why would I travel for an inferior experience? And that, COVID or no COVID, that's a universal. So we believe that the growth we've seen is going to continue for years and years to come. I will tell you of interest, Emily, the total addressable market as we see it is close to 200 million gym goers around the world. We have just under 2 million subscribers. So we could grow, we believe, 100x before we're starting to really feel like the growth may slow.
Wow. Well, those customers will need bikes, those new customers. The supply constraints, have been tough in an otherwise record year. What is the latest on your efforts to improve that part of the process? And when might a customer be able to order a bike and get it in a few days?
Yeah, it's a great question, Emily. It has been taxing us for the last couple quarters, and I'm happy to report that as of today, the answer is 2 to 4 weeks for our core bike business here in the States, which is again a Herculean success from our team, considering the demand is still so robust. It was really a testament to us increasing the supply chain capacity, getting the bikes largely from Taiwan through the port of Los Angeles and through the port of Long Beach and into our fulfillment centers and then into our new members' homes. So we've finally got on top of the order to delivery that had been plaguing us for a few months.
So let's talk about the hardware pipeline. Will you be putting out iterations annually? What will the new bikes look like? How often do you think consumers will replace them?
Yeah, it's a good question. I will point out that last year, about 6 or 8 months ago, we launched a brand new treadmill, lower price tread, where we announced it, and we're bringing it here to the States in the next couple months. And we announced a new bike, to your point, the Bike Plus, that allowed us to lower the price of our existing bike or our V1 bike. And so we are, innovation and R&D is at our core. It's in our DNA. So we're going to continue to innovate on the bike line, on the tread line. We're working on other products and other categories. We've said we are committed to winning strength. We don't just want to be cardio. We're largely on track to win cardio globally. We want to make sure that we win strength globally. And so I actually get to go out to one of our R&D labs in Secaucus every couple weeks, and it's really energizing for me and the teams to see all of the cool stuff, not just hardware, but new software and new content, and all the different modalities that you'd expect us to come out with.
So we're going to talk about software, but does that mean a strength training machine or a rowing machine could be next?
Those are good guesses. I can't confirm or deny, but we're having fun. Fitness is a fun category, and yeah, you can imagine some of the things we're working on.
So let's talk about the content. You did a big deal with Beyonce. I'm curious how much you're spending on content and if we're going to see more deals like that.
Well, sure. That was a great partnership, and it just wasn't just on music. It's a broader partnership with Beyonce that we're very excited about. But you're right, on and on. The Beatles, across the board, all kinds of big partnerships. And to answer your question, Emily, we're spending tens of millions, going to hundreds of millions of dollars with our music partners, with the publishers, with the labels, directly with the artists, and it's what our members want. We're innovating on that content front. And absolutely, you're going to see a lot more of that type of stuff coming from Peloton.
So let's talk about the competition. Obviously, Apple is making inroads. We heard Mark mention Nordic and Echelon. What do you think about the prospects of your rivals?
Yeah, I mean, it's obviously a great legitimization of fitness streaming content as a category. I mean, for years and years and years, no one believed in us. And now you have Apple saying this is an important enough category that we're investing in streaming digital fitness as well. And then on, you're seeing some of the big players from fitness of yesteryear trying to create connected products and then other newcomers. But it really is, I think, legitimization and saying everyone in the industry is seeing that the future of fitness is at home. So it's somewhat flattering. I do think that the consumer is going to win. If there anytime there's a competition for innovation, the consumer wins, which is great. More people getting healthier. Of course, I'm biased. I think the real innovation and the sexiest products and content and software and experiences are going to come out of Peloton. We're not resting on where we are today. We have, I think, over $3 billion on our balance sheet, and we're going to invest it in innovation. And I think we're going to win if it is a global winner-take-all opportunity, which I believe it will be. We're going to make sure that Peloton is well positioned to take advantage of that.
So speaking of global, you're expanding into Australia, and Peloton is still in just a handful of countries. How rapid do you see expansion around the world, and when will Peloton be a truly global company?
Yeah, Emily, it's something we think about a lot. Our leadership team is all over this, and we are anxious to get to every country. It's frustrating that there are people who want Peloton products in different countries, and we hear about them all the time, and we're not there yet. Fortunately or unfortunately, our vertically integrated model, where we have stores and we have delivery vans and delivery folks, and we do our television content or television marketing. We have, when we went to Germany, we of course went with authentic German instructors and German language. And so it's a slower process getting to these stores or getting to these markets in the way that we want to, in such a vertically integrated, high touch way. The other thing we're balancing, Emily, is that the growth that we've experienced every year since we launched the company is so robust that we don't want to stress our team out beyond what was the crazy 12 months we just had. For us to say we're going to go to 15 new countries in the next 12 months would be tough to choke down. So we're trying to do it prudently at the right rhythm so that we can deliver for our new members and create the experience and the brand that we want in each one of these new markets.
All right, well, we'll be watching as you try to reach that, big TAM that you were talking about earlier and take on the globe. John Foley, CEO of Peloton, thank you so much for joining us for our special coverage of the pandemic 1 year on. All right, coming up, Facebook makes an impactful change, offering paid leave to victims of domestic violence. What Chief Operating Officer Sheryl Sandberg told us next. And as we head to break, let's take a look at chip stocks on the rise. You're looking at Micron there, Intel, Broadcom, NXP. Of course, we've been following the global chip shortage, boosting chip stocks across the board. We'll keep watching. This is Bloomberg.
We have very broad leave policies. We had leave for this before, but I think this is us really recognizing that this is something that affects everyone, including our employees. It's a situation where you need paid time off, and not just for yourself, but for a loved one.
That was Facebook COO Sheryl Sandberg speaking at the Bloomberg Equality Summit. Facebook announcing it'll extend its paid leave policy to workers who are victims of sexual assault and domestic violence. All employees globally will be able to take as many as 20 paid days off if they or a relative have been the victim of a crime. Facebook's policy previously was only for U.S. employees who were victims. And that does it for this edition of Bloomberg Technology. Tomorrow, we've got a great show with Qualcomm, Sal Khan of the Khan Academy, Roelof Botha of Sequoia, and more.